Thank you, everyone, for joining. I'm excited to talk to you for a little bit about the One Big Beautiful Bill. And if you'll all forgive me, for purposes of this session, I'm just going to call it the bill. I've found that it's a little bit of a tongue twister and can get caught up in all the B's. So hopefully that works for everyone. We are going to use the conferences link. And here is the CPE chicken. So the session is going to qualify for CPE if you attend the live webinar. If you're watching this as a recording later, it does not qualify for CPE. The conference's IO app is going to help us track attendance. So either go to ksm.cnf.io and choose the session, or use a QR code on your screen, and make sure you check in to this session. This session will qualify for 1 CPE credit. You have to stay with us for at least 50 minutes and enter 3 of the 4 code words. I expect we're going to have some time at the end to talk through some questions. So if you'll humor me and let me get through some of the content, we will be watching the Q&A, so please feel free to lob your questions in the Q&A, but also at the end, I'll try to take some questions if you have them. So we're going to talk a little bit today about the bill, the One Big Beautiful Bill, and I'll give you a little bit of background about that. We'll talk about the effects on individual and corporate giving. There's been a lot of buzz about how charitable giving may be affected. And I do remember back in 2017, when the Tax Cuts and Jobs Act came, there was a ton of talk about how the increased standard deduction was going to really, really affect giving. And I think we've found that it's not been affected as much as initially expected. And although I hope that you all receive lots and lots of charitable contributions as a result, I think there is some concern that these changes to charitable contributions will greatly affect your donors, and hopefully at the end here you'll determine that maybe the impact is not quite as drastic as what has sounds in the media or in little articles. So we'll talk through that. We'll talk about some strategies. Some of these will be based on the new bill, but some of them will be some old tried and true strategies that we're going to just review a bit. Always a good reminder. Talk about a new federal credit that's coming, and some new taxes on nonprofit organizations. That'll be a quick one. And then just talk about planning. How do you think about this at your charitable organization? What might things do? So really just thinking about what these changes mean to your organization. Okay, so the One Big Beautiful Bill, just some context here, the One Big Beautiful Bill was signed on July 4th of 2025, and it is an amendment to the Internal Revenue Code. It's phasing in, so there are some aspects of the One Big Beautiful Bill that are effective in 2025, some in 2026, some in 2027. So we'll talk about that a little bit. I want to remind everyone that this presentation today is just focused on a very, very small piece of the bill. It's not a comprehensive summary. We do have several sessions about all of the different provisions in the One Big Beautiful Bill, and I would encourage you to take a look at some of those sessions. There are a ton of changes, and so really today I am just focused on how are nonprofits affected, especially in the way of charitable contributions. And so this is just going to be a little sliver of the changes that the One Big Beautiful Bill brought. So I encourage you, if you're curious about some of the other things, to seek out some of our other webinars that have been recorded. Okay, just a reminder before we get started. I'm cautioning everyone on this call. If you're attending this session, my guess is that you've got a connection somehow to a not-for-profit organization. whether you work there, whether you're a concerned donor, whether you're on the board. And even if you feel very, very comfortable with these rules, you're not your donor's tax expert, even if you feel like you're an expert on this topic. Every donor situation is incredibly nuanced, and I've got a bunch of examples in here that are just that, they're examples. And so there's so many situations where, these very simple examples that I share today might sound like they apply to your donor or might seem like they would. And there may be a scenario that you just don't know about. Individual taxes are incredibly complex. And so what I've attempted to do is given a few examples today that kind of demonstrate the way the law works. But I want to remind you that these are very simple and they can't just be applied to your donor. And nor should you assume that your donor would know how to apply these to their situation. Again, just looking at the changes to the rules in a vacuum can be a little bit dangerous. Your clients have business income, they have other things, and so just understanding that you may not see the whole picture is just very, very important here, so that we don't get in a situation where we think we're sharing something with a donor to help them and it ends up, not having the effect that we hoped for. So just a word of caution. I hope that this presentation will give you an awareness, but it's not something that I would expect folks that are not-for-profit to necessarily implement or inform. Okay, so let's talk a little bit about the individual side. There's a couple of things that have affected individual giving specifically. So I'll talk a little bit about those. That's probably the area with the most changes related to not-for-profits in the bill. So just for some context, back in 2017, the Tax Cuts and Jobs Act significantly raised the standard deduction. And what that meant was taxpayers that for a long, long time had been itemizers and itemized their deductions on their tax returns, many of them started to take the standard deduction. And although this is a big part of the bill, raising the standard deduction and allowing higher deductions, those who were already taking the standard deduction got a much bigger deduction. Many people worried, as I alluded to earlier, that the raising of the standard deduction would disincentivize charitable giving. Also added a state and local tax deduction cap, as what we refer to as a SALT cap. And this actually probably had a bigger impact than the standard deduction change, because many, many people for years and years itemized their deductions because of their state taxes. And with this cap, we saw taxpayers with very high income levels, all of a sudden, if they didn't have a lot of charitable deductions and they perhaps didn't have a lot of mortgage interest, those folks all of a sudden became standard deduction takers. And so big change in 2017. Also with the SALT cap, there were some miscellaneous itemized deductions that went away. And so as you'll see here, more taxpayers took the standard deduction than ever. So that was a big change back in 2017 with the Tax Cuts and Jobs Act. And you'll see here the effects that that continues to have with this big, beautiful bill. I wanted to make sure I put in that historical context because it's really important as you start talking about these new limitations to itemized deductions. None of this matters if the people are on a standard deduction. So we'll kind of talk through that a little bit. So that's your historical context. Okay, so non-itemizer. So this is a very important piece. During COVID, there was a small deduction for non-itemizers. They call it an above the line deduction. And basically what it meant is even if you didn't itemize your deductions, on top of the standard deduction, there was an additional charitable contribution. So that is back starting in 2026, not for 2025, but 2026. A deduction of $1,000 for single or $2,000 for joint filers. Again, this is on top of your standard deduction. So just a few caveats. It has to be a cash contribution. So gifts of securities don't count. The bag of stuff you take to Goodwill does not count. It's got to be cash. And the charitable organization cannot be a supporting organization, and it cannot be a donor advised fund. You'll see that a few more times in this presentation, but very important to note that the donor advised fund is not able to accept these types of contributions, or they're not deductible on your return. So make sure it's directly to a publicly supported charitable organization. Put in here the standard deduction. So this would be on top of that. So there are more taxpayers than there used to be that are now incentivized by a tax benefit for charitable giving. Will that or will that not make an impact? We're not really sure. I do think there were lots of organizations during the pandemic when the smaller deduction was made available that really reached out to their smaller donors and were making sure that folks knew about this because it was so new. So certainly an added benefit for the massive amount of people who are now taking the standard deduction. Okay, this is our first code word, and since it's the first one, I'm just going to draw your attention to it. Make sure you're using the code words on the conferences.io app. Give just a second for everyone to get that put in. Okay, this is a little bit more about individual giving. So for itemizers, so we're switching gears here. Our first example was for those taking the standard deduction. For itemizers, there is a new floor. And so the way this works is any itemizers have to first exceed 0.5% of their adjusted gross income in charitable contributions before any donation becomes a deduction. So this is another one I've heard a lot about. There's a deduction, there's a haircut to the charitable contributions. We're very worried about that. And will people keep giving? It's really important to note that the calculation is on the adjusted gross income, not on the charitable contribution. And so it's kind of difficult to quantify because depending on where your charitable contribution is compared to your AGI, the limit can look a lot different. So it's not as easy as saying, okay, if we give a $100,000 contribution, how much of that is limited? It really depends on the other factors in your donor's life. And this goes back to why I've said that this can get complex and to just be aware of how things work. So that's our floor. The ceiling is still also in place, and it's been made permanent with this bill. So the donors are also limited to 60% of their adjusted gross income at the top level. Anything that's above that 60% adjusted gross income will carry forward to the next year. And I'll kind of talk a little bit more about that later, but that's important to know. Just thinking about the logistics of things, sometimes you'll have a donor that, for example, has accumulated wealth over their lifetime and maybe is retired. So they're willing to give significant gifts because their assets are high, but maybe their current year income is not as high as it once was in their working years. And so you'll find that that 60% ceiling can also affect charitable giving as well. Excuse me. Because of this, some of your wealthier donors may lose some of their tax deductibility. I'm going to show you a few examples of that here on the next couple of slides, and hopefully that will make some sense. Okay, so this is just the very first piece, very simplistic example. So in this example, in the first example, we have a taxpayer that has a $500,000 adjusted gross income. And so you can see they're planning to make a $25,000 charitable contribution. So the 0.5% of AGI is $2,500. And so instead of deducting $25,000, they're allowed to an itemized deduction of $22,500. I don't know coming into this if folks were worried about this, but I guess what I would say is there's been a lot of chatter about this, and I want to assure you that perhaps for some of your donors, this isn't quite as significant as maybe we thought. So again, example one, limited by $2,500. Example two, we're giving the same amount of contribution, right? Our contribution doesn't change, but in this example, our adjusted gross income changes. And so I want to demonstrate here that although your charitable contribution is exactly the same, in example one, you can deduct $22,500. In example two, you only get a $20,000 deduction. So really important to understand the charitable contribution can be the same. The amount of the deduction can be quite different. In example three, we've got a $5 million taxpayer AGI, and even at 4 times the charitable contribution, you'll see that the floor amount, the limitation amount, is much more significant. And just as context, I've had a couple people just in conversation say, well, how much of the deduction is limited? If you look at these examples, in the first example, we've got about 10% limitation of the charitable. Second example, about 20%. And then the third example, we're limited to 25%. So just again, remember the limitation is based on the adjusted gross income in the year, not necessarily the charitable contribution. And because you, as a not-for-profit organization, aren't necessarily going to know the adjusted gross income of your donor, can be pretty difficult to talk about these things just in the context of a charitable gift. Okay, further complicating things, there's an additional limitation, and that is a limitation on itemized deductions overall. And so I didn't illustrate this piece in the first example. The first example was just the haircut to charitables overall. So for individuals in the highest tax bracket, the 37% bracket, all of the itemized deductions will start being capped. And so even after the charitable deduction haircut at 0.5% of AGI, there's an additional haircut. And this one gets even a little bit more complicated because under the new law, the total value of your itemized cannot reduce your tax bill by more than 30%, 35% of the amount deducted. So there's a complex calculation, and I'm not going to get super deep in the weeds on that calculation. But the important thing to understand is those that will be affected, for example, single filers are over the 626,000 or 751,000 for joint filers. So it is your taxpayers in the upper income brackets, but especially for small business owners of flow-through entities, this amount can be reached fairly quickly. So making sure that your development folks, your internal folks understand that the donors in the highest tax brackets, they might think about accelerating that gift into 2025. So for 2025, these limits are not going to be in place. And so I'll show you a little bit about, there's been some discussion here about accelerating gifts. And I'm going to show an example here in a moment. One of the things that we've discovered as we've been talking internally is it seems like the first thing is, okay, let's accelerate gifts, let's put them all in 2025. And I'm going to show you some reasons to do that. But after I talk through these examples, I want to circle back to, it doesn't always make sense for your donors. There may be scenarios where this doesn't make sense. And I want to remind everyone that one of the things your donors may think about is, for example, if they've committed to a 3-year gift, maybe the knee-jerk reaction is, let's accelerate that all into 2025 so we can take advantage of the old tax laws. I encourage donors to consider also the time value of money. So for example, one of our clients came to us and said, okay, should I accelerate this gift all into 2025? And we talked about a few scenarios. We talked about some carryover of the charitable deduction when it exceeds the 60%. And one of the things the client said that was really interesting is, well, it seems like this haircut isn't enough then I'm not going to make up that much in interest if I keep this amount invested over the 3-year period rather than accelerating it into the current year, which I thought was very interesting and something that we emphasize with our clients, making sure we see the entire picture of the situation and not just letting the tax tail wag the dog. Very important. So let me look at an example and I'll kind of show you what that looks like. Okay, so in the first two examples here, we've got a pre-2026 example and a 2026 example just to illustrate the differences. So we have a taxpayer with $1 million of AGI. In the first two columns, you'll see that in 2026, firstly, we have a haircut, the floor of 0.5% of AGI. So after that, instead of a $50,000 charitable contribution, we've got a $45,000 contribution. And then let's say that they've got the maximum amount of state and local tax itemized deductions, but no other itemized deductions, which I understand is really unlikely, but go with it for this example. You'll see that the additional overall itemized deduction limitation is almost $3,000. Now, I don't know what you guys had in your head about the additional deduction, but $3,000 isn't, is it in the grand scheme of this $1 million taxpayer AGI isn't as significant as what maybe you might initially think. So you'll see that the taxable income in the two columns, if the same exact contribution was made pre-2026, your taxable income would be $940,000. But with the limitations, you end up with a $947,000. I'm showing an additional example here with a much more significant income and gift example. And you'll see here, again, because these calculations are made with respect to the AGI, we have an overall floor limitation of 50,000, so much more significant, and a itemized deduction limitation of $105,000. So you'll see as the income changes, for those in the 37% tax bracket, it significantly changes the limitations as well. Okay, I think there may be some questions about individual giving. Unless something's particularly urgent, I'm going to save those to the end and get through the content and then open it up for questions. I want to talk a little bit about corporate giving. And some of this relates to some of the conversations that I've had in other sessions that we've had for our clients. If you joined us in July for the presentation from the Lilly School of Philanthropy about the corporate giving report, or I'm sorry, the USA Giving Report, you'll know that the vast majority of contributions come from individual donors, and corporate giving really makes up a small percentage of charitable giving. But it is something that my clients focus on very intently. And so just making sure everyone understands the new limitations to corporate giving, pretty important here. Again, remember that just because you're dealing with a business doesn't necessarily mean they're corporate in the sense that they'll be subject to these limitations. Many businesses are what we call pass-through organizations or pass-through businesses. And so those entities, even though you may receive a contribution from the business, those deductions pass through to individuals. So again, I would just want to remind you all, it's not your job to understand the ins and the outs and the structuring of all your donors' personal tax issues, just that these are out here and to understand maybe why behavior may be affected, maybe why you get certain feedback from your donors. So an update to corporate giving. So corporations, this is a similar floor, kind of similar to what was happening with the individuals. So the level of contribution has to be at least 1% of the corporation's taxable earnings. But there's also the ceiling, and the ceiling has not changed and has been in place for some time. So the ceiling is a 10% cap. And so to the extent contributions exceed that 10% ceiling, they can be carried forward for 5 years. I want to remind everybody, no changes to sponsorship payment deductibility. And so this is a question I get a lot of times from our business clients. Hey, listen, we did this sponsorship, but for us, it was a little bit more about marketing, right? We sponsored an event. It was a business expense. And so the 162 rules that govern whether something is an ordinary and necessary business expense remained unchanged. And so sometimes there's a play between, is this a a pure charitable contribution? Is this a business expense for the business, or is it some combination of both? It's possible we may see corporations scale back on corporate giving. You know, corporate responsibility has been a huge focus lately. And so it is possible that corporations won't make a change because they'll understand the PR implications of all of that. We'll just have to see what the effect is. And so just being mindful of these changes for your corporate donors is an important part of nonprofits being aware of what's going on. So I'm going to give you another example. This is again a corporation, so a C corporation. In our first example, our taxable income before charitable contributions is $200,000. Example two, $1.2 million. And example three, $10,000 of taxable income. Now, in all three scenarios, we're making the same charitable contribution. We've got a $10,000 charitable contribution. And it's also important to note that this one big beautiful bill also brought a ton of changes to businesses and their tax rules. And so even businesses that are highly profitable and successful at times for tax purposes can have losses. We have depreciation rules. There are new limitations for research and experimentation, and we've got a whole session on that. But I just want to let you know that it can kind of seem like, well, surely this corporation doesn't have a low taxable income because they're very, very successful. Being a very, very successful and profitable business does not always mean that the taxable income is significantly high. So you'll see in each example, we've got a 1% floor of the taxable earnings. So $2,000, $12,000, or $100 in each of these different examples. And then the ceiling. So we have to be above the floor, but below the ceiling. So in the first year, or I'm sorry, in the first example, we're allowed an $8,000 deduction because we contributed 10,000, we take the $2,000 haircut, and we're still below the ceiling. So our deduction is 8,000. In the second example, we didn't even exceed the 1%. And so because of this, we get no benefit for the charitable contribution. And so, it's interesting to note that in years where your taxable income is significantly high, those, I'll call them smaller charitable contributions, may not be beneficial at all. In the third example, because our taxable income is low and it's essentially the same as our charitable contributions, we exceed the floor, but we're well above the ceiling. And so what happens is we only get that $1,000 deduction because that's the 10% of our taxable earnings. And the excess carries forward for 5 years. So it's important to know that above the ceiling carries forward, but below the floor, we just lose that permanently. So you'll see there's a $1,000 deduction in example number 3 and a $9,000 carryover. And this can be used in future years for 5 years. Okay. The other thing to note is that 9,000, when it carries into the next year, it's again subject to the 1% haircut. So making sure you're kind of aware of those carryovers, really important. Okay, I'm gonna pause a second here. I've been talking a lot, and so I'm gonna take a drink and let you open the code word, get the code word entered in for your CPE. All right. Let's talk a little bit about some strategies. and what those might look like, some of the things you might talk about internally. Just remember, I've said this probably too many times, but you don't know the entirety of your donor situation. So making sure that they have someone that they're consulting on the tax side is really important. Okay, I'm going to talk about grouping donations in 1 year, and you'll often heard this called bunching. This can get really complicated, and so I have a few examples, but they're very simplistic. And so I'll just remind you that we're going to look at a scenario where this may be very beneficial, and that benefit is important for us to talk about. But also, you should know that there are plenty of scenarios where this benefit gets diminished. I was just talking to one of our clients the other day that was talking about bunching. And when I talk through these two examples, I'll kind of explain a scenario where we determined it really wasn't all that beneficial and we decided not to do the bunching strategy. So remember, this 0.5% reduction is applied each year. This is even more useful for folks that are not in that 37% tax bracket. So to the extent that you can avoid that second standard deduction haircut, the bunching strategy becomes much more powerful. Remember that 2025 does not have the floor limitation, the 0.5% floor. That only comes into account in 2026. And so, for example, for folks, you may have people that have committed to something over 3 years that decide it really is beneficial for me to get this all contributed in 2025. So you may have some conversations there. I'm just going to put a caveat here. Make sure you are aware of this overall 60% limitation. So what that means is on the corporate side, we talked about the floor and the ceiling. There's a similar ceiling for individuals. You're limited to 60% of your adjusted gross income. Now, anything above that carries forward, just like it does for the corporations that we showed in the last example. But it's subject then again to the floor. And so when you have those charitable contributions, if you get to a point where you're exceeding the overall limitation of 60%, you may then carry it into the next year and be subject to the 0.5% haircut again and kind of defeat your purpose. Okay, so let me show you an example of bunching. So on the left, we have a $25,000 charitable contribution that's made over made each of 3 years for a total of $75,000. And then on the right, we've made the $75,000 contribution in 1 year instead of over 3 years. So we're assuming income is the same. This has got some really, really big assumptions that perhaps are not applicable to your taxpayer. So bear with me on the simplicity here for demonstration purposes. So on the left, you'll see that each year we're subject to the floor amount of the 0.5% of AGI, so $2,500. And so each year you can see the itemized charitable deduction. We'll add in the state and local tax itemized deduction, just assuming, again, we're getting the maximum amount. You'll see that there's no standard deduction limitation because these folks are not in the highest bracket. So at a $500,000 AGI, you're not in the 37% tax bracket. So you'll see your overall taxable income is the $1,402,500. And so if you made that contribution over 3 years, over the 3-year period, you'd have $1.4 million of taxable income. Now, conversely, let's say you made the $75,000 gift in 1 year with a $500,000 AGI, and then each year's remaining, you made no charitable contributions. Again, these are pretty simplistic assumptions, but for purposes here, assume that you made no additional charitable contributions. So in the first year, you'll have the 0.5% haircut, and with your state and local itemized deductions, you'll have taxable income of $417,000. For the additional 2 years, your taxable income will be $470,000. And remember, even though you have no charitable contributions in those 2 years, you'll still get an estimated, this number changes each year, $30,000 standard deduction. So the result is you have additional deductions of 45,000. If you compare the two scenarios, you're better by $45,000 of deductions. So you'll see the difference in the taxable income numbers there. So again, very simple, very basic calculation, but that kind of demonstrates how taking advantage of the standard deduction and getting less of the floor amount haircut on your charitable contributions can really help the donor. This is a different example with a higher taxpayer. And so again, very similar scenario. We're making a $50,000 charitable contribution each year in 3 years, or we're making the contribution in 1 year. This taxpayer has $1 million AGI, and so you'll see the floor amount for each year is $5,000. They have the state and local tax deduction as well. That's the same for all. But remember, folks in the 37% tax bracket have the additional overall limitation to their itemized deductions, which is represented in the $2,973 number in each of the examples on the left. So you'll see your taxable income 2.843 in the first scenario, and then in the bunching example, 2.7. So additional $50,000 of deductions in this scenario. So still very powerful tool, even when you're subject to the second haircut. I said this before, but I'm going to reiterate. To the extent that your charitable giving exceeds that 60%, and you have some excess contribution that carries over into the next year, it's not the end of the world, but then it becomes a charitable contribution in that year, and it will be subject to the 0.5% floor again. And so there are scenarios where you think you're bunching something into 1 year, but if the charitable contribution is such that it exceeds 60% of the taxpayer's adjusted gross income, you'll be subject to that ceiling I referred to earlier, and you'll have to carry that forward, and you'll lose some of the benefit of bunching. So just making sure we're aware that it's not quite as simple as the slides make it out to be, but it's also not the end of the world. When you have a taxpayer that's making a $50,000 contribution, hopefully they're not losing a ton of sleep, over losing a fraction of that. I'm going to talk a few strategies. And so I want to remind everyone of the qualified charitable distribution. This is really, really a powerful tool for donors over 70.5. So when you're 70.5, you are required to take required minimum distributions from an IRA. And basically what the QCD does is it allows the income to never hit your tax return as taxable income. And so when you make a charitable contribution from your QCD, from your IRA, your overall income is reduced, but you don't get a charitable contribution deduction. And the reason this is so powerful is multifaceted. One, it never hits your adjusted gross income. So your adjusted gross income can be lower by this $108,000. And the reason that taking it out of income is better than having it as a deduction is it lowers your overall AGI for all those limitations. You're not subject to the same haircut and ceiling that we just talked about for charitable contributions and itemized deductions. Some folks, if they can make their contributions this way, then can become non-itemizers. And so you get that additional 30,000-ish of standard deductions on top of the expenses you're already incurring. So this is a really powerful tool. The donors I have that are doing this, it's really something that's powerful and a great way to use IRA funds that maybe a taxpayer is not necessarily needing to fund their lifestyle, and really significantly lowers taxes in a meaningful way. I want to remind everyone that you cannot fund a donor advised fund with a qualified charitable distribution from your IRA. So that's very, very important. Private foundations cannot be funded this way. Supporting organizations cannot be funded this way. So just be careful when you're talking about qualified charitable distributions, making sure they're going to the right organizations. Remember, non-cash contributions are incredibly powerful. And I think sometimes we forget how beneficial this is. If your organization cannot accept stock donations today, I would encourage you to make sure that that's something you put in place. So keep in mind that when you donate capital assets, especially very, very easy to donate appreciated publicly traded securities, you kind of have a double whammy from a tax standpoint. You have the benefit in that you get a charitable contribution for the fair market value at the time of donation. So if you've got something that's highly appreciated, even if it's not significantly appreciated, that appreciation will never be taxable to you. So if you look at the example here, I've kind of demonstrated that. Okay, if we bought something for $2,000, it's now worth $3,500. If you sold that stock and donated the cash, you would get a $3,500 charitable contribution, but you'd have taxable income of the $1,500. When you donate the appreciated securities, you get the best of both worlds. So you still get the $3,500 fair market value, but you avoid capital gains tax on the earnings of $1,500. So really important. These are small numbers just to illustrate how that works. But if you've got taxpayers with, a significant, especially publicly traded portfolio, it's something to think about. Some organizations have gotten sophisticated enough that they can accept non-publicly traded securities. I would just make sure you approach that with caution. I have some clients who have started accepting gifts of Bitcoin. Again, just make sure you're consulting your tax advisor or your broker to make sure you're dealing with those contributions correctly. I'm going to talk very briefly about this new federal credit. It's pretty specific, but it's pretty interesting, and I'm hopeful that I have many clients that take advantage of this. There's still a lot to come on this. It does not go into effect until 2027. Indiana specifically has some experience with this because we have a similar state SGO credit. So scholarship granting organizations are eligible for a federal credit of $1,700. This is a non-refundable credit, so you only can take the credit against tax that you have. So taxpayers that their income is low enough that they're not paying income tax, they'll have to carry this forward. And it's also important to note that to the extent you receive a credit at the federal or state level, you have to reduce the deduction that you're taking from an itemized deduction standpoint. I've got a few of the eligibility requirements for these organizations, but make sure that your organization feels comfortable that they qualify for this credit. And this has not happened yet, but we expect that there will be a list of eligible organizations and organizations that are interested in participating in that will need to be listed on this list. It is also important because I get asked this a ton. You cannot earmark this contribution for certain students. That is a problem. And so making sure that this goes to a program that allows applicants and everyone can apply and be treated fairly, very, very important. So more to come on this. Just wanted to get you starting to think about this new credit. Code word number 3, make sure you're putting in 868. Give everybody a minute to get that code word in. Let's talk a little bit about some changes to tax on nonprofit organizations. This isn't a significant effect to our KSM client base, but I want to make sure our clients kind of are aware of what's going on here. So currently, there is a tiered investment income tax on private colleges and universities. Currently, the excise tax is 1.4% just on the investment income, not on all income, not on contributions. Starting after 2025, there's going to be a tiered approach. So to the extent that your endowment per student is less than $500,000, so the folks under $500,000 will be exempt from this tax. Between $500,000 and $750,000 per student would be the 1.4%. And then above 750,000 to 2 million will be at 4%. And then endowments that have endowments per student above 2 million will be at an 8% excise tax. So pretty big changes there for organizations that have significant endowments, but maybe a smaller student count. And again, this is just on net investment income. If you know anything about private foundations, kind of a similar concept to the way private foundations are taxed. This also expands investment income to include interest income on student loans, royalty income from intellectual property. And so, much more tax will be paid on private colleges and universities with these really, really significant endowments. So big change in that very, very specific area. For some of my clients, this is outside of colleges and universities, but for any nonprofit organizations that currently have executives or others that are compensated in excess of $1 million, previously that excise tax was only for the top 5 compensated. So to the extent you have folks that are compensated in excess of $1 million, more than 5, this then expands. And it's a 21% tax on comp exceeding $1 million. I have had a few organizations get a little bit surprised by this because it's really important to look at compensation and what that term, encompasses. So I've had scenarios where, our salary is well below $1 million, but for example, we have deferred compensation, and that adds a whole element depending on when it's awarded, when it's earned, when that goes into your compensation calculation. And so for organizations with highly compensated individuals, just being very careful of, especially deferred comp plans or things like that, that can really affect and get closer to the $1 million than maybe you initially thought. Just a few more minutes here. Wanted to remind everyone that starting in 2026, threshold for 1099 reporting is going to increase. And so, this is when you have services provided by, say, a vendor, and you compensate them. So way, way different than charitable contributions here for a moment. Just understanding that threshold for reporting is going to increase significantly to $2,000. So being aware of that. So what can I do about this? How can I talk about this internally? I think it's just a good time to talk to your donors and how the changes might affect your work. So, what does your donor base look like? Do you think it'll stay pretty steady? Is there a chance that you can receive more funding and capitalize on some of these deductions for non-itemizers? Do you have big corporate gifts that you're worried could disappear? Making sure the donors understand multi-year commitments, how those commitments can help with stability. There's some opportunity here, making sure donors may be interested in giving more in 2025 for bunching, making sure that doesn't affect future years. Planning is important. So cash forecasting, when things are coming in, when they're going out. So just being aware. Gift restrictions, I think, are also a really important part of this. So to the extent that your donor says, hey, I've committed to something for 3 years, but they're nervous about giving up that cash, putting a gift restriction on it could be a way to kind of assuage their fears if they're worried about making sure that contribution lasts over maybe a program period. Restricting that gift and making sure that they understand that gift can only be used, or it can be used over a certain time period. So just because the gift's funded ahead of time, it may need to be used over a 3-year period. They get to take the deduction in the beginning, but you can restrict the use over a certain amount of years. Talk to your donors, understand where their head's at. If they've talked to their tax advisors, they may really appreciate a heads up that these things are changing. Make sure they think about it. Just being aware of how that might affect your donors, I think, is super helpful. Going to give you another code word to enter, code word 210. Okay, I have one more reminder. Please make sure you're not giving tax advice to donors. So many times, I think our nonprofit organizations want to be helpful, and I think that's wonderful. And understanding and relaying information is great. But the examples I've shown on the screen today are very, very simplistic. And so even just getting to that adjusted gross income number is very, very complex and involves a lot of things that you are likely not aware of in your donor's life. So making sure that you're aware of how complex those things can be and just not giving concrete tax advice is very, very important. Okay, I'm gonna open it up to questions, see if there are any questions that folks want to talk about. I wanted to, just while you're coming up with those, I wanted to two things. One, briefly thank my colleague Jennifer Grady. Jennifer, thank you so much for getting material together. And I know Jennifer has been answering a few questions in the chat. Jennifer is part of our KSM nonprofit team. And KSM is dedicated to the nonprofit space. It is one of our largest industries. My partner Justin Hayes and I are very, very vested in helping our communities. And so we're excited that you all have joined our nonprofit group. But I will open it up to questions at this time. Anyone who's attended this session should receive a recording of the session afterwards. I would love for you to reach out to me directly if you have any questions, and happy to hear from our clients. Sam, thank you for your comment. I really appreciate it. And thanks for coming today. Zarina, thanks for your questions. Appreciate it. Maybe a thank you. Thanks for coming. Appreciate it. I'll keep an eye on the chat for just a few more minutes. Before you leave, if you could check out of the conferences.io app, this will check you out of our CPE. If you've been here for the 50 minutes, you'll receive CPE and answer the code word questions. If you have any questions, please let us know. Thanks for coming, everyone. Kelly, thanks for coming. Appreciate it.
There was a question in the Q&A.
Whoop, sorry, I had muted. Zarina's asked a question about a university. And Zarina, a little bit. The only reason that a university giving a gift now would change their scenario is if that gift lowered their overall investment income. And of course, if your total assets is reduced, in theory, your investment income would be reduced in the future, but it won't be a one-to-one deduction. Not-for-profits won't have that same deduction scenario that, say, an individual or corporation would have. So I would say universities will probably not have similar motivations than individuals. So yeah, that would be Zarina, for the university making a contribution, really won't be affected year over year, other than if they have an endowment. So no effects to income tax for a tax exempt entity, and only if they were subject to the net investment income tax on the endowment would any of this affect that university. Thanks for asking. Jennifer, I think we can close down. Thank you everyone for coming. Appreciate it.